Hi everyone, I think we're going to get started. I'm excited to welcome Gary Antonacci. He's the author of the award-winning book, Dual Momentum Investing, an innovative approach to higher returns with lower risk. He's here today to talk about dual momentum investing, and it'll be a very exciting talk. We're going to leave some time at the end for questions, so keep your questions in mind and we'll let you know when we're ready for that. Thank you, Gary.
Thank you. Good morning, and welcome to Dual Momentum Investing. How many actually use momentum as part of their investment process now? Great. A little bit about myself. I've spent 40 years working with underexploited investment opportunities. 7 years ago, I undertook a study of momentum. I read all the academic research on it and concluded that momentum was very powerful, but it wasn't being used very well in the marketplace. So I did my own research, wrote three papers on momentum, two of which won the Wagner Award given by the National Association of Active Investment Managers. I've written a book, Dual Momentum Investing. Much of what we'll go over today is included in the book. Our agenda will be: what is momentum? Why does momentum work? What are the issues associated with momentum? And how you can best use momentum to earn higher returns with less risk. So what is momentum? Newton says a body in motion tends to stay in motion. Now this applies to the financial universe as well as the physical one. It means assets that are strong continue to be strong. What does this mean that we should do? Buy strong stuff. Newton did this himself. In the early 1700s, South Sea stock was what everyone wanted to own. So Newton jumped in, doubled his money very quickly, took his profits, and was very happy, until he saw all his friends becoming rich beyond the dreams of avarice, while Newton sat on his assets. So he re-entered the market with everything he had, and things went well for a while, until they didn't. At first, Newton thought, it's got to come back. Then he hoped it would come back. Then he prayed it would come back. It never did. Newton lost all his money, the equivalent of $3 million. Does this pattern of investing look familiar to anyone here? Just me? Who remembers Newton's third law of motion? For every action, there is an equal and opposite reaction. I wonder where he got that idea. The first person who understood what to do about it was the classical economist David Riccardo, who said, cut your losses short, let your profits run on. Riccardo put those ideas into practice. He retired at the age of 42, having amassed $65 million in today's terms. Other prominent investors also made use of momentum principles. Jesse Livermore said, invest with the trend, buy stocks that are making new highs. Richard Wyckoff said, buy the strongest stocks in the strongest industries in the strongest index when the trend is up. Wyckoff retired to an estate in the Hamptons where he was the neighbor of Alfred P. Sloan. Now this type of ad hoc momentum investing is great if you have a good sense of the markets. But what about the rest of us? We need something systematic, that's rules-based, that can be back-tested and replicated, that we can have confidence in and go out and do ourselves. Fortunately for us, this research was done back in 1937 by Cowles and Jones. They tabulated the performance of every New York Stock Exchange stock from 1920 through 1935. There were no computers back then. This was painstaking work that they did by hand. After they looked over the results, here's what they concluded. The tendency is very pronounced for stocks that have exceeded the median in 1 year to exceed it also in the following year. This means stocks that were strongest last year continue to be strong this year. Now, this is a very important finding. It forms the basis for momentum as we see it and practice it today. This finding was so important that guess what happened in the area of momentum research over the next 60 years? That's right, nothing. Not a thing. And why was that? Economists were jealous of physicists. They wanted finance to be more of a science. So while they recognized that stocks drift upwards over time, they said that otherwise they behave randomly, like pollen grains jiggling around in water. This random walk hypothesis soon evolved into the efficient market hypothesis. This says that because people are rational, if there are abnormal profits to be had, investors will arbitrage them away very quickly. So the only thing that really makes sense is to own the market portfolio. The efficient market hypothesis had a stranglehold on finance for over 30 years. It only started to loosen in the early 1990s. And what brought this about? Behavioral finance was the first thing. In the 1970s, two psychologists, Tversky and Kahneman, published some papers in a book in which they showed people could be consistently irrational. And that's all people, not just my ex-wife. Next, in the early 1980s, Fama and French, two of the fathers of efficient markets, came out with some research showing that value and size factors can explain some of what goes on in the market. So perhaps we could do something other than just own the market itself. And finally, in the late 1980s, there was research showing that mean reversion exists, first on a long-term basis. This means stocks that have been strong over the past 3 to 5 years tend to underperform going forward, and vice versa. In 1990, mean reversion was found to exist on a short-term basis as well, 1 month or less. Momentum is the opposite of mean reversion. It's persistence in performance. If mean reversion could exist, why couldn't momentum? So in 1993, Jegadeesh and Titman published a seminal study on momentum using US stock market data from 1962 through 1989. They segmented the market into deciles, comparing the top 10% of stocks to the bottom 10% ranked on momentum. What they found is that 3 to 12-month momentum works. Stocks that have been strong during the preceding 3 to 12 months continue to be strong over the next 3 to 12 months. The question is, how strong? And the answer is extremely strong. I extended their study back to January 1927 and forward through December 2014. The winner column represents the top 10% of momentum stocks, ranked on 12-month momentum, skipping the last month because that's mean reverting. The loser portfolio is the bottom decile, ranked by momentum. If we compare the return of winner versus loser, that's over an 18% swing. That's an incredible difference. Even if you compare the winner portfolio to the S&P 500, that's almost 700 basis points extra a year from employing stock momentum. When economists saw this, they got very excited. They also got upset because it meant efficient market hypothesis may not hold up. So what they did was they explored momentum every which way they could in hopes of either validating it or hopefully invalidating it. That's been going on for over 20 years. What they've discovered, though, is that momentum works, not just with stocks, but with stock indices, sectors, bonds, commodities, currencies, pretty much everything, from the year 1800 right up to the present time. This is a study done last year by Geksky and Samanoff, looking at 250 years of global multi-asset momentum. This is the excess return of the top third of these assets ranked by momentum. That's the blue line. The red line would be the bottom third of excess return ranked by momentum. We can see not only has momentum been strong, but it's been consistent over time. Now, practitioners, when they find a model that works, sometimes only over 10 or 15 years of data, they get excited. They think that they found the holy grail of investing. But academics want to see more than that. They want to see validation on out-of-sample data. They want to see their model holds up on multiple markets. They want to see that it's consistent. They want to see that the parameters are stable. Momentum accomplishes all of these things. Most importantly, though, they want to understand the reasons why it works. Quantitative finance, behavioral finance, provides us those explanations. What first happens when information enters the marketplace is there is an underreaction to the information. This is caused by anchoring or conservatism. People are reluctant to make changes. There's also the slow diffusion of information. People don't pay attention right away. And there's the disposition effect. This is the tendency we all have, behavioral heuristic, to sell winners too soon and to hold on to losers too long. Following an initial underreaction to information, there's a catch-up process. And following the catch-up process, there's a later overreaction, caused first by herding. This is a very powerful behavioral instinct we all have. It exists throughout nature. It's what keeps animals safe in the wild. We all tend to want to follow the crowd. So when we see things moving financially, we want to get on board. The bandwagon effect. There's representativeness, which means when we see something happening near term, we project it into the future and assume that it's going to continue. This leads to confidence and then overconfidence, which can cause an extension of whatever trends that there are. So what have we seen so far with respect to rules-based systematic momentum? We've seen high and consistent returns, that it works with all assets, that it's persisted over time, and that there are good reasons for it. In the face of all of this, economists had to accept it. Fama and French declared momentum to be the premier market anomaly, one that's pervasive, and that's an embarrassment to the efficient market hypothesis. Let me ask you a question now. Given what we've seen so far about stock momentum and the way that it's practiced in the marketplace, how many of you think it looks pretty good and you might want to invest this way? Quite a few. Who knows what this is? It's the wool being pulled over your eyes. There are serious issues associated with momentum. The first of these is scalability. Momentum is a high turnover strategy. Turnover can be 300% a year. It can be 10 times the turnover of a value portfolio. Momentum stocks tend to have wide bid-ask spreads because they're more volatile stocks. This shows what happens with respect to how concentrated and selective we are in constructing our momentum portfolio. If we have a 50 stock portfolio out of a universe of 500, that's rebalanced monthly, we have a 17% return annually. As we become less selective and have a larger portfolio, our return drops considerably. The same thing with respect to our holding period. As we allow more time before rebalancing, our return also drops. So where we ideally want to be is up in the upper left quadrant. We want to have a concentrated, focused portfolio that we rebalance frequently, no more than quarterly. In 2006, there were 0 publicly available momentum funds. Today, there are over 15. There are a same number of multi-factor funds that also use momentum. Our friends at Alpha Architect put a list up every month of the top 100 momentum stocks for everyone to see and use. Now, what do you think is going to happen when hundreds of billions of dollars all try to enter and exit the same small group of stocks every quarter? This is starting to happen now and can only get worse over time. Related to the issue of scalability is the one of trading costs. Lesmond did a very sophisticated and conservative study of what those trading costs would be for a momentum portfolio. And they concluded trading costs could amount to 7% a year of assets. This completely eliminates any profits to be had from a stock momentum portfolio. Now, Frazzini et al. Over at AQR said, oh, it's not really so bad. AQR manages a lot of money in momentum. They had a 12-year database of their own, and they said, you can do some things to minimize that. A more recent study by Titman and others, Titman as in Jegadeesh Titman, studied actual observed bid-ask spreads, and they said trading costs were much closer to Lesman's figures than they are to Frazzini's. A forthcoming study coming out by Jason Su, co-founder of Research Affiliates, looks at the impact of momentum on a large cap portfolio before and after trading costs. Before trading costs, there's a nice advantage, 2.7% a year. After trading costs, that advantage disappears. We're at a disadvantage, even with quarterly rebalancing rather than monthly. Let's take a look at the performance of the 2 oldest momentum funds. The first of these is the PowerShares DWA Technical Leaders ETF that began in March of 2007. It's represented by the red line. This is a focused portfolio of 100 stocks, which is good. The ETF has $1.5 billion in assets. Morningstar says the comparable benchmark for this fund is the Russell Mid-Cap Growth Index. There's an ETF for that, which is the blue line. Which would you rather have, the blue pill or the red pill? Here's the next oldest fund, AQR Large Cap Momentum Mutual Fund, began in 2009. It has $1 billion in assets. However, AQR has 7 additional public momentum mutual funds, a large hedge fund, and multi-factor funds that all use momentum. So they're not able to have a 100 stock portfolio. Their momentum portfolios are over 400 stocks. It's the AQR fund is the red line. Its benchmark is the Russell 1000 Growth Index. The ETF for that is the blue line. Again, which would you rather have? Based on what we know now about scalability, trading costs, and the performance of the oldest momentum funds, scalability hasn't even kicked in much on these. If any of you still want to go out and invest this way, then I have this bridge I'd like to sell you. It's right over here. So what do? Buy and hold until we get old, go cold, grow mold. If you felt that, you wouldn't be here today, and neither would I. Now remember, momentum works well with everything. In my first momentum research paper, I was able to show that momentum works better with stock indices than it does with individual stocks. This is before transaction costs. In the study I mentioned earlier by Geksky and Samanoff, where they look at 6 different asset classes, they also found that stock index momentum outperforms the other assets. So why don't we take a look at momentum applied to the stock indices? We'll need at least 2 in order to have relative strength momentum. You have to compare one to another. Which indices shall we use? U.S. equities make up a little over half now of the global market capitalization. So let's use the S&P 500 as one of these indices. And to keep things simple, we'll just use the rest of the world as our other one. And we'll construct a model of relative momentum that switches between the S&P 500 index and the MSCI All-Country World Index ex-US, based on whichever of the two has been stronger during the preceding 12 months, and we'll rebalance that portfolio monthly. We choose 12 months as our look back because that's what Cowles and Jones found worked well in 1937. There's no data mining this way. Here are our results. The red line is the S&P 500 index from 1971 to the present. The gray line is the MSCI World Index. The blue line above those is relative momentum, which you get by switching between the two. If you look closely at the chart, beginning, say, in the early 80s, you can see the All-World Index outperforming the S&P, and the blue line of relative strength moving right along up with it. In the 90s, the S&P takes over the lead, and our blue line moves up with it. After that, all the indices go down. The All-World Index in the 90s goes up faster than the S&P. Our blue line goes up with it. Following the last bear market, the S&P takes over the lead, and our blue line goes up with it. We're hopping from one to another, as if we're moving from a slower moving train to a faster moving train. And we keep doing that. The end result is an increase in return over the averages of 300 basis points a year, just from doing this. Now, as a buy and hold investor, why wouldn't you be interested in that? 300 basis points a year from this simple strategy. You don't have to mess with smart beta or risk parity or finding models that overfit your data. This is all you have to do. Now, is there any reason why you might not want to do it? I came up with one, possible one, I mentioned in my book. The world is more globalized today. Large corporations have operations all over. So there may not be as much value to international diversification on a company level. However, that's not what's really going on with respect to where most of our profits come from. This is a chart of the US dollar index in red and the ratio of US stocks to non-US stocks in blue. We can see the correlation. When the dollar is strong, US stocks tend to underperform non-US stocks. So what we really have here is a global macro orientation. We don't need to invest in a hedge fund to do that. We have it right here. Does it make sense to be long and short simultaneously the US dollar? It doesn't, does it? But what most people do who invest in a global portfolio is they're long US stocks and non-US stocks simultaneously. That's what I call vertical diversification. What happens there is that whatever asset is weaker and underperforming creates a drag on our performance. What momentum does is provide us with horizontal diversification or temporal diversification, in which we diversify over time. We invest dynamically in whichever assets are strongest at the time. Is there any downside to this at all? Well, the downside is the downside. We still have bear markets. So what can we do about that? How do people usually reduce the risk that comes from holding stocks? They diversify, right? And what do they typically diversify with? Bonds, correct. But before getting there, let me point out why we need to do that. Many of you are probably familiar with the Dalbar report. It shows past 20-year annualized returns for investors in equity mutual funds versus the S&P 500 index. Equity fund investors are at a disadvantage, 45% less return than from just investing in the index. And why is that? Remember our friend Newton, who bought high and sold low. People have shifting risk preferences based on their emotion, fear and greed. Greg Fisher said, we don't have people with investment problems, we have investments with people problems. That's why we need to do something about it. The problem with the permanent allocation to bonds is that the expected return is much lower. This has not been the case over the past 20 years, but looking long term, it certainly has been. From the year 1800 through 2012, the annualized excess return from stocks was 6.6% a year, and from bonds, it's only been 3.6% a year. Bonds are less risky than stocks, so they should have a lower return. Bonds are not without risk either. The worst real return drawdown since 1900 has been 73% for stocks and 68% for bonds. Since 1807, the worst rolling 10-year real return has actually been worse for bonds. Now, I'm not saying not to use bonds. But why don't we take a page from what we saw earlier, where we switched between US stocks and non-US stocks when it made sense? Now, when does it make sense to be in bonds? How about when stocks are weak? When stocks start to weaken, it's an indication of a coming recession. Stock market is a leading indicator. When that happens, the Federal Reserve takes notice, and they try to lower or keep low interest rates in order to stimulate the economy, which is good for bonds. When stocks go down, there's also a tendency for investors to shift their assets from stocks to bonds, and for new money entering the marketplace to enter into the bond market. Fortunately, there's a way we can tell when stocks are weak. There are two types of momentum. The first we've been talking about is relative, where we compare performance to our peers and choose whichever is stronger. The second type is absolute momentum, where we compare performance to ourselves over time. Let me give you an example. Let's say the S&P 500 has gone down over the past year. We say it has negative absolute momentum. The trend is down. It should continue to go down. Momentum is persistence in performance. If the S&P 500 has been positive over the past year, it has positive absolute momentum. It should continue to go up. So let's put together an absolute momentum model using the S&P 500. We'll switch between it and the conservative Barclays U.S. Aggregate Bond Index. This has a duration of only 5 years. and it's all investment quality. We'll use our same 12-month look back, and we'll rebalance monthly. So if the S&P 500 has gone up over the past year, that's what we'll be invested in. If the S&P 500 has gone down, we'll move over to aggregate bonds, and we'll reevaluate monthly. Here's what that looks like. Our red line is, again, the S&P 500. The smooth gray line is the return from aggregate bonds. And our blue line is what we get from absolute momentum applied to the S&P 500. If you look closely, 1973, you can see the blue line, absolute momentum, avoided the bear market that the S&P went through. It followed the S&P all the way up until we got to 1999. We entered into a bear market again. But absolute momentum switched over to absolute bonds and avoided most of that bear market. The same thing happened 2008. There was a little bit of a dip. It avoided most of the bear market, and then it picked up again with the S&P. Now, absolute momentum will not get you in or out exactly at tops or bottoms. It's trend following. It's similar to a moving average, but better. Zachamulin has some research reports, one of which he compared absolute momentum to 5 different moving average systems, and he found that absolute momentum worked best and was statistically significant. The extra return we earn from absolute momentum is 240 basis points over the return of the S&P. And we've avoided all 3 significant bear markets along the way. If you had to choose between relative momentum and absolute momentum, which would you choose? I'd choose absolute momentum, absolutely. But you don't have to make that choice. Why not do both? That is my contribution to the investment world. What I call dual momentum. First, we use absolute momentum to see whether we want to be in stocks or bonds. If we're going to be in stocks, then we use relative momentum to tell whether to be in US stocks or non-US stocks. Monthly rebalancing, 12-month look back. The red line is the S&P 500, the gray line, the world index, the steady yellow line, absolute momentum, the green line, relative momentum, and the blue line, dual momentum. Let that sink in for a moment. This is the most important table you'll see here today. We'll start from the bottom and work up. We have the S&P and the world indices on the bottom, with returns of around 10% a year. Standard deviations, which we're used to, 15 to 17%. Worst drawdowns on a month-end basis, a little over 50%. When we move up to relative momentum, our return jumps up to 13%, a 300 basis point increase in return. However, our standard deviation remains high, similar to what the indices are. The same with our worst drawdown. When we move up to absolute momentum, we get a nice increase in return, 12.6%, compound annual growth rate. Our standard deviation drops down to 12%. We're in ag bonds 30% of the time. Volatility goes down. Our worst drawdown dips to under 30%. Now, when we move up to dual momentum, our return is 16.7% a year. This is almost the same 700 basis point increase in return we saw earlier with stock momentum. And we don't have the same issues. You can invest as much as you want in the indices. There's no scalability issue. Transaction costs are not an issue. There's 1.3 trades per year on average. And perhaps most importantly, you avoid those horrendous bear markets for the most part. Our standard deviation, 12.6%, our Sharpe ratio, 0.87, and our worst drawdown, under 20%. Let's look under the hood to see a little better what's going on. This is every bull market from 1971 to the present. The average bull market return for the S&P 500 has been 278%. If we were to use only absolute momentum, only trend following, our return would have been 218%, because there are occasional whipsaws where we get false signals, get out and have to get back in. Also, there are lags in getting out and back in the market. However, because of dual momentum and the benefits we get from relative momentum part of it, our return 293%. Dual momentum outperforms even in bull markets. Where it becomes more interesting, though, is in bear markets. The S&P 500 has lost an average of 37% during each of these 5 bear markets. Relative momentum has not fared much better than that. Dual momentum, however, has converted those losses into gains. We've achieved crisis alpha. If we look at that a little differently, we'll examine histograms of rolling 12-month returns. The top one is the S&P 500 index. It has a range of minus 45% to plus 65%. The middle chart is dual momentum, with a range of minus 20% to plus 95%. When we overlay dual momentum on top of the S&P, you can see how we've eliminated most of the left tail risk and extended the right tail of returns. We have some very nice positive skew going on here. What are the advantages of dual momentum? High returns, no limit to what we can invest, high scalability, low trading costs, low left tail risk. Are there risks, though? Of course. There are risks associated with every investment. There's tracking error. Every model has tracking error. And we have to be willing to live with that. Sometimes investment professionals cannot do that. They'll get fired because of tracking error. This gives us an advantage as individual investors. We don't have to worry about getting fired, unless you have a girlfriend like mine. Now, what happens when you have this tracking error is that it's usually following bear markets, when dual momentum has dramatically outperformed. You also have whipsaws and lags in bull markets because of absolute momentum. However, we've seen that if you're patient, relative momentum will help to offset that. And you have short-term volatility. This should not be underestimated. In 1987, dual momentum suffered the same drawdown in October that the stock market did. And that's good. It didn't get whipsawed out and then have to get back in at a higher price. You have to be willing to accept short-term volatility. That's what fuels these kinds of extraordinary returns. We should embrace that volatility instead of avoiding it. There are 3 secrets of success for dual momentum investing. The first is patience. This is a get-rich-slow program. Warren Buffett has said the stock market is a mechanism for transferring wealth from the inpatient to the patient. Don't just do something, sit there, is what we have to keep in mind. We need discipline. Discipline to stick with the model, and also discipline to not mess with it when things temporarily are not going our way. I get emails all the time from people saying, how about doing this? Or have you looked at that? And I'll usually respond, well, do you have a good reason for thinking that that's going to work, other than it just fits a little bit of data? And have you back-tested it on over 40 years or so of data? Usually I don't hear from them anymore after that. And you need understanding. Understanding will give you discipline and patience and confidence. I've just touched the surface here today on what momentum and dual momentum are all about. To learn more about it, you can read the research papers. There's a ton of them now. Momentum has been researched more than anything else in finance over the past 20 years. You can follow my blog, and you can read my book. There are only 2 investment books that have over 100 ratings on Amazon that have been able to maintain a 5-star rating overall. Mine is one of them. My book has easy do-it-yourself instructions for implementing what we've seen here today, as well as a lot of additional background information. Before finishing up, I'm happy to take any questions that you might have. Yes, sir.
Thank you for the talk. And you mentioned that one signal is stronger than the other, so we should switch to the stronger one. Can you be more specific about how to define stronger? What is the time window they look at, and what's the criteria?
Whichever is outperformed during the preceding 12 months.
12 months.
12 months, yes.
So, so for different time period, I think for the exit, when you do the switch, so you will have to liquidate one signal and get into the other. You consider the transaction cost of doing that.
There's a transaction cost, of course, but with relative momentum, the number of trades per year is less than 1, and with dual momentum, it's 1.3 on average. So there are very few switches. Also, if you want to do it on a real-time basis, to switch simultaneously, you can do that using a charting program that shows real-time prices. Stock Charts has a module called Sharp Charts, which updates real-time. So toward the close, you can see if you're going to get a signal, and then you can get out of one and then into the other right after that.
Thank you.
Yes, sir.
If theoretically, if momentum strategies work, and we also know that reversion to mean strategies work, how do you explain that on a theoretical basis? Because they appear to be the opposites of each other.
Excellent question. Yes, they are the opposite of each other. And a lot of people don't realize what's going on here, and it's an important concept. The reason they both work is because they pertain to different time frames. Mean reversion is long-term, 3 to 5 years. It forms the basis of value type investing, where something's been knocked down over a long period of time. It also applies on a short-term interval of 1 month or less. So many people who do day trading, and try to follow the trends, it doesn't work. I locked myself in a room for a year with TradeStation, trying to find day trading methods, on a short-term day type basis, and they would fit the data beautifully and never hold up. And that's because those markets are mean reverting on a short-term basis. Momentum is an intermediate term phenomena from 3 to 12 months, and especially from 6 to 12 months.
Thank you.
Yes, sir.
When you're deciding whether to go to bond and equity, what process are you using for equity? Are you using like S&P or? So you're talking about this dual momentum. So you first decide whether to bond or equity.
Yes.
And then if it is equity, you decide whether it's U.S. or the rest of the world.
Yes.
So what instrument do you use to compare when to decide whether bond equity?
For bonds, I'm using the Barclays Aggregate Bond Index, and there are several ETFs that correspond to that. And for U.S. equities, I use the S&P 500. It works really well. There's 3 different ETFs you can use for that. They're highly liquid and very low expense ratio. And the same thing for non-U.S. Stocks. There are a couple of ETFs for that as well. Yes, sir.
From your analysis, did you ever sort of keep going? So, okay, now S&P 500, I can go in there. what if now look at 10 sectors, which one of
Mhm.
those I should go to? Now, what if I, where do you stop in terms of asset comparisons? And because you can always find a, league table of,
Right.
ranked securities or ranked assets that are outperforming another bunch. So why not
Yes.
just keep going until you get to something liquid enough that you can
Yeah.
switch into?
I do keep going. I've done a lot of additional research on momentum, and I have what I call my dual momentum sector rotation model. I've looked at pretty much everything you can, but there are several issues there. First of all, this approach works best when your volatility is decent but not too high. Because it's long-term trend following, if your volatility is too high, you give up too much profits before you can get out. And that's the problem with individual stocks and with sectors. Initially, I had data on sectors going back to 1990, like everybody else, and I put a mention of that in my book. However, later I was able to get data all the way back to 1970, and sector rotation did not hold up as well. The drawdowns were larger and the returns were lower once you have more data. We're really data hungry and data driven when we do this kind of research. Does that answer your question?
Yeah, I think so. I think the volatility part makes sense because they're going to be smaller segments of the market, so they're going to be swinging.
Right. You have to have shorter look backs, and then you end up with a lot more whipsaws when you do that.
One more question.
Yes, sir.
It seems like conceptually, the time series momentum or the absolute momentum is similar to the moving average crossover.
Mhm.
Because if your price goes below your moving average, then you switch to like a bond or something. So then, why is there a difference in performance? And the intuition is the same.
Well, they're similar, but not quite the same, because with the moving average, it's kind of like a half span because you're using an average of the prices. With momentum, you're looking at the two endpoints, your return from one point to the other. They're similar, they are related, but research has shown, and it's been tested, that absolute momentum does work better. I prefer using the longer look backs because it minimizes whipsaws and transaction costs. If you compare this to, say, a popular 10-month moving average cross or a 200-day, you'll find a lot more trades doing that.
Question. Do you think absolute momentum will continue working then interest rates are zero now?
Mhm.
So once that realizes that we have a recession, what they're going to do? They're going
Mm.
how bonds will outperform everything else? There's nowhere to go.
Well,
From zero, maybe negative.
yeah, well, we're in bonds only 30% of the time. Now, we're not in bonds all the time. We don't have this drag on performance. So what happens is interest rates rising will be good for us because when we are in bonds, we'll capture a higher return. Also, because interest rates have been so low and depressed for so long, the stock market hasn't had a break. It's gone up for 7-8 years now. And where dual momentum really shines and outperforms is when you have market cycles, when you can hold on to your assets and make money in a bear market when everyone else is losing money. So I think on a comparative basis, we'll actually do better in a rising interest rate environment.
Thank you very
Okay.
much.